I work for Marsh McLennan Agency, and we are an independent agent, but, and I'll kind of explain that to you in a little bit. But what I really want to do today, let me get the clicker here, is go through, there's a couple disclaimers here. Go through really some foundational insurance information, what's going on in the industry right now. Everybody's, Hurricane Ian is a big topic at the moment, and flooding, everything is the wildfires. Let me tell you, I've been in this business for 30 years, and I don't think that this industry has been such in turmoil this entire 30 years, except for maybe in 2008. And I think that actually it's probably worse than 2008 was back then. So I'm going to go through the carrier environment, what insurance carriers there are out there, and what's happening to them. For example, there are insurance carriers in Florida at the moment that have completely dissolved. They don't even exist any longer. There's been a lot of insurance carriers that have been bought out, probably within the last 5 years, and the market is going haywire. So the insurance companies of old, some of them don't even exist any longer. And I'll kind of talk about a little bit on a next slide about what's going on with the insurance industry in general, because it's what we call a hard market at the moment. And so I'll kind of explain a little bit what that means. The differences between direct carriers and independent agents. As Carmen mentioned, we are an independent agent. A direct writer is going to be more of like a State Farm, Allstate, Geico. When you go to them and you call them and to get a quote, they will give you, have only access to their insurance quotes and their premiums. When you call them, you are calling an employee of State Farm, an employee of Allstate. With an independent agent, we actually, and it's not just myself, any independent agent out there, we represent several different insurance carriers, and we represent the client themselves. So when somebody comes to me, we have anywhere between 12 to 15 different insurance carriers that we represent, that I take that information, I look at the portfolio, I look at the exposures, and I look at the risks, and I'll go out to market with it to try to find a carrier that's going to be complementary with pricing as well as coverages to what that client needs. We also work for our clients. So we actually advocate for them. We have claims representation, so that in the event that there is a claim and you're having problems with a carrier getting a claim paid, or timeliness, or anything like that, or maybe even understanding the contract, the policy of what it covers and what it doesn't cover, we actually will step in to try to be the advocate for our clients. So there's a big difference between direct writers and independent agents. The difference in carriers and coverages. Along with the direct writers as well as the independent agents, direct writers have are policies that are great for some people. For some people, they might need a little bit more robust of a policy. And that's where going to an independent agent is going to really help you, because they do have the large variety of the different types of insurance carriers with different coverages, different contracts that can actually provide those coverages for clients. You do sometimes pay for what you get. Not all policies are created equal, and not all coverages are created equal, and we'll kind of go through that later in the presentation. But you do sometimes really do pay for what you get. And then how to choose the right agent. One of the things that I always tell people is you need to make sure that you are choosing an agent that not only has the risk management approach, kind of looks at the entire insurance portfolio holistically to try to make sure that there are no gaps in coverages, make sure that if you make a change on this policy that it's not going to affect that policy, or if there is, that they know exactly how to make that change. But also make the recommendations. Start asking questions about people's lifestyles. Do they like to travel? Do they like to collect antique cars? Do they like to collect wine? You know, there's all sorts of different things that we as agents, we want to get to know our clients so that we can understand what their lifestyle is like and actually give recommendations on how to protect it. You know, wealth advisors like Carmen, they actually do a really good job of protecting your future assets and protecting, do the estate planning and protecting it to go to the next generation or for retirement. And in one single car accident, it could be wiped out. So it's really important to find that trusted advisor, somebody that is going to be your agent that's actually going to work with your wealth advisor in order to work with them hand in hand to make sure that whatever changes that you make on that side of the house reflect on the insurance program as well. And we'll kind of go through a couple examples of that as well in the next couple slides. Hard market versus soft market. This is something that we are in the midst of at the moment. Some days I just wonder why I got into this industry, especially with Hurricane Ian. The last couple weeks we have been prepping for the hurricane, then the hurricane. When a hurricane or a storm comes, honestly our hands are tied and we don't have anything to do because we can't quote. The insurance companies have put moratoriums on any kind of placing coverage or obtaining quotes or anything like that. So our hands are tied while the hurricane is happening. And then post-hurricane or post-catastrophe, many times our hands are still tied. I was just telling Carmen earlier, there are carriers out there that still have holds on quoting any new business or obtaining any new policies. And we won't, like Lloyd's of London right now, they've put a hold on everything. They won't issue any new policy, even if it's a brand new car. They won't do it for certain counties, certain areas of the state. So the insurance industry is very similar to the real estate market. The real estate market is a buyer's market or a seller's market, right? Well, the insurance industry is a hard market or a soft market. The hard market basically is the insurance premiums go up. You all have probably seen it with your insurance policies. I know I have with mine. But the insurance premiums will go up. The underwriters and the insurance companies become very conservative and they narrow their scope of what they are willing to insure. So a soft market is the complete opposite. The insurance rates are stabilized. Sometimes they even decrease. But the insurance carriers will write anything and everything they can get their hands on. That's a soft market. Right now, we are in an extreme hard market. And there's several reasons for that. For one, the catastrophic events. We just talked about Ian. That's just one of the events. The wildfires in California are not just in California any longer. They're now in Colorado, Arizona, Montana. All of those are starting to go east. And all of that is starting to affect the insurance industry and their loss ratios and how much that they are paying out in claims. Claim soft cost. A lot of people don't realize this because up until the pandemic, it wasn't that big of a deal. I mean, it was a big deal, but it really wasn't that big of a deal because if you got in a car accident, a couple weeks, you'd be able to get your car back. Something happened to your home and, in a month or two, you'd be back in it again. The soft cost with claims is all those soft expenses that aren't necessarily the damage that the insurance companies are actually paying to repair. It is the rental car reimbursement. Instead of the insurance companies paying 2 weeks for a rental car, they're now paying 2 or 3 months for a rental car because the supply chain. For homes, you can't even get appliances, let alone doors and windows. So instead of maybe 2 or 3 months out of your home if there's a fire, now it's maybe 3 to 6 months. Those are the soft costs that are actually included in the claims numbers when the insurance companies, because those are all things that the insurance companies are now paying out for, that historically they never had to pay out because the supply chain and the materials were always readily available. So the soft costs are a big thing with the claims at the moment. We talked about supply chain, labor shortage. This is one thing that we'll talk about when we talk about homeowners insurance. It's critical that you have certain types of coverage underneath your home policy because what happens is that when there is a catastrophic event, for one, there's a labor shortage because everybody wants their roof fixed. And then for two, now the contractors can charge double than what they previously were 6 months prior to, right? Because the demand is there. So it's really important to be able to have that type of home coverage that's going to be able to cover in the event that the insurance claim is more than what your insurance policy says. And then the fuel cost. There was just the news just yesterday or this morning about the gas prices going up. The fuel, a lot of people don't realize this, but when fuel costs go up, when there's an oil spill in the Gulf, it all affects your insurance because all of a sudden PVC piping, asphalt shingles, they all use petroleum. That's not even including the actual cost of getting materials from point A to point B to get you the materials to the location, and then from point B to the actual house or automotive place in order to be able to actually get those materials to the place, to the people that need to fix it. So all of that is now included in the costs of what it costs now to actually repair either homes or cars or whatever it is. So right now, this is the hard market. It's, like I said, it's the hardest that I've seen probably since 2008. And with inflation now increasing so much, it's only, unfortunately, probably going to get worse, because now the insurance companies are starting to put inflation guards on your home policies, so the valuations and the replacement cost of your homes are increasing it at more of an exponential rate than it has been probably in the last 5 years. Differences in carriers and coverages. We'll talk a little bit about this. These are just some of the insurance companies that we represent. We represent lots of other ones as well. I didn't want to smatter the whole the whole slide with everyone that we represent. But each one of these carriers offers something different. There are certain carriers that tailor more to more of the million-plus homes, and then there's carriers that tailor more, with million-plus lower or million lower. So each carrier is going to be a little bit different, and that's what you need to really kind of be cognizant of, is what are you actually buying? What does the contract and the policy say? How is it going to affect? What's going to happen when you do have a claim? So it's important to know exactly what you have and what you're purchasing. I tell all of my colleagues that work with me, 80% of our job is education. We deal with smart people. They've become successful for a reason. So they will, if you educate them about what they have and what they don't have, they will make the decision on their own of what limits of liability that they want. Or, once you explain what the coverages will or will not cover, they will choose what's important to them. Homeowners insurance. So the differences in coverages. Many insurance policies will say that you have guaranteed replacement cost on your home policy. And many times you do, but a lot of people don't understand that there's 3 different types of guaranteed replacement cost. There's a guaranteed replacement cost that the insurance will pay up to the policy limit that you insure your home for. Then there's others that have an extended replacement cost, which means that you insure your home for, let's say, $600,000, and they will in the event that there's a total loss, they will pay anywhere between 10, maybe 25, 50% more than that. It's an extended replacement cost. Once you get to that percentage cap, that's all she wrote. That's all that you'll obtain. Then there's an unlimited guaranteed replacement cost, which means that if you insure a home for a certain value, let's say $1 million, and it costs $5 million to replace because all of a sudden, what we previously talked about, the labor shortage, they're charging you more than what they normally would have a few months prior. Now that's an unlimited guaranteed replacement cost. They will replace your home no matter how much it costs to replace. So there's differences in coverages, but on policies, it usually says just guaranteed replacement cost. You have to kind of dig a little bit more in order to be able to find out exactly which type of guaranteed replacement cost you have. Built-in coverages. Some insurance companies, they just give you like the standard homeowners insurance policies. Others will have built-in coverages, such as the unlimited guaranteed replacement cost. The other is a cash-out option, which means that if you have a total loss of your home and you say, you know what, forget this, I don't want the maintenance, I'm going to go buy a condo somewhere, and I don't want to rebuild, and I don't want to rebuild on this site. You can cash your policy out for the amount of that you are insuring your home for, and you can take the money, you can go do whatever you want with it and sell a piece of land, and you're good. You can go invest it with Carmen if you want to, right? And then the third one that's built into the many policies is what's called a large deductible waiver. And it means that if you have a claim that's more than $50,000 of a loss, they waive your deductible completely. And I will tell you that the most frequent claims that we are finding are water damage claims. It's a burst pipe. It is a washer that the hose has come off or deteriorated. It is an ice maker hose in the refrigerator that has been leaking and nobody knows until it's too late, and now you have to replace your entire kitchen floor, right, and subflooring. So the water damage is actually the most common type of claim that we come across. But those types of things are built, the large deductible waiver, the cash out option, and the unlimited guaranteed replacement cost many times are built into the contract of the policy. It's not something that you can extract and say, I don't want that one thing, give me a discount. It's in there, it's what you have. But then there's other carriers that they don't even offer that type of coverage because they aren't filed with the states that they're selling insurance for or selling insurance in. So they can't even offer it to you even if they wanted to. So there's differences in the different coverages and the different policies and the different contracts. It's important for you all to know what those differences are. Then there's endorsements. You can add certain things, right? You get the basic home policy and you can all of a sudden a la carte start adding things. One of them is the cyber. That's a big topic right now. It's different than identity theft. So identity theft is a pretty good staple on any home policy, but cyber is something a little bit extra. And that's a whole nother conversation. But cyber coverage, equipment breakdown coverage, we're finding that that's a lot used a lot of times in the new smart houses, where people can remote into their home and change temperature and change this and change that. That's the equipment breakdown is where we find a lot of that. And then differences in titling. This is one thing that, this is why it's so important that you have an agent that works closely with whoever is helping you with your estate plan or your finances. Because if you title a home, if it be your primary home, if it be a secondary home, if it be a rental piece of property, if you title it in a trust or an LLC, it's important that your insurance policies reflect that entity on your policy. It needs to either be a named insured or it needs to be an additional named insured, so that that entity has coverage and protection in the event that something were to happen. So it's important that you make sure that you communicate that with your agent, or to make sure that they understand how the ownership works. And again, that's why it's really important for the agent and the wealth advisor to work hand in hand. Differences in coverages for auto. So we saw the beautiful cars out there, right? I was walking around looking inside of them. Quick little personal story. My son is 23. And he's been saving up, and he has his regular car, but he went and about a month and a half ago bought a 1969 Ford F100 pickup truck. And he is like in heaven with this thing, right? So now it does not look nearly as nice as those out there, but he's working on it. He wants to paint it baby blue at some point. But auto policies, I will tell you, back in the day, I would tell people an auto policy is an auto policy is an auto policy. That's not the case any longer. There are differences in auto policies, as maybe not as much as there are on home policies, but there's still differences in auto policies. The main one is the agreed value. You can have an insurance policy on an auto that you total it out, and all of a sudden you're haggling back and forth with the insurance carrier about Blue Book, about how much you're going to get paid on this totaled out vehicle, right? With an agreed value policy, there's a stated amount on the policy that you know exactly how much you're going to get paid in the event that it's a total loss. There's some insurance companies out there that will actually, depending on the year of the vehicle and when it was added to the policy, that will give you just a replacement car. So there are differences. The other thing is OEM parts. In the event that there is a claim, many insurance carriers out there will only repair your vehicle with aftermarket parts, which can be not necessarily ideal, especially if it's a newer vehicle, right, or a more valuable vehicle. So you want to make sure that you have those differences as well. And then the last thing on auto policies is that they actually, some insurance companies will give worldwide liability coverage. So if you're traveling outside the United States and you're renting a vehicle, you don't need to purchase that insurance with that rental car company. It is automatically given, the liability portion is automatically given on your personal auto policy. But again, those are only for certain carriers, right? So again, make sure and check with your insurance agent to see which type of policies you have. The other thing is, not all insurance companies will insure the antique vehicles out there or the high performance vehicles, high valued vehicles. So you need to go to either different markets or find a carrier that's actually can insure both your day-to-day vehicles as well as those Sunday driving cars, right? The ones that you only drive every so often. So you need to make sure that you have either a combination and that they give you that antique rate, which is usually typically a lower rate, or find a company like a Hagerty Insurance that will insure those that specialize in the antique or classic autos for a lower rate. They'll give agreed value. They know how important these are to their owners, right? It's a passion. It's more of a passion collection than it is anything else. So you need to make sure that you have the proper policies depending on which type of vehicles and what type of coverages that you want. Personal excess liability policies. This is something this has been the hot topic for years. Trying to explain, for one, what it is, and for two, why it's so important to have. So the excess liability policy and an umbrella policy, those terms are somewhat interchangeable. Most people will use either one or the other, and most of the time it's pretty the identical type of coverages. The excess liability policy is a second layer of liability that goes up and over your primary insurance policies, your primary home insurance, your primary auto insurance, a second home, a rental piece of property, a boat, a motorcycle, whatever it is, whatever you personally own, a personal asset that you insure, the excess liability policy goes up and over that in the event that there's a lawsuit. So it's really important. I mean, honestly, I tell everyone to have one, no matter how much you're worth or not, because the world is so litigious at the moment that you'll get sued in a hot minute for anything. The excess liability policies, depending on the insurance companies that the policy is with, they will go up to multi-millions. And then also, depending on the insurance company, the defense costs can be outside the policy limit, and it can be unlimited. So other insurance companies, the defense costs are within the policy limit, and it's not unlimited. So if you have a $1 million excess liability policy, that has to pay for the settlement and defense. If you have an excess liability policy that is outside, the defense costs are outside the policy limit and unlimited, you can have just as equal amount of defense costs as you can for the settlement. There are different things that you can add on to an excess liability policy. One of them is the EPLI. It's short for Employment Practices Liability. This is something that's not as common as most things, but that is in the event that people have domestic staff. And when I say that, people are like, I don't have any domestic staff. Well, most of the time it's either because of nannies or au pairs or someone like that. That's the most common type of domestic staff or employee that we have. The EPLI coverage will cover in the instance that there's wrongful termination, discrimination, harassment. That kind of thing is not covered underneath an umbrella policy or an excess liability policy. The other one is a nonprofit D&O, directors and officers liability. This is for people that actually sit on nonprofit boards. So if you are on a board that is a nonprofit organization, most of the time the organization, the entity, will have a D&O policy for the actual entity or organization, but many times they don't necessarily cover the individual board members. What this covers is coverage for the individual for misallocation of funds, wrongful termination, discrimination, anything like that. So not all insurance companies offer these coverages, and so that's another thing to check into. If you do have an excess liability policy, do they offer these types of coverages? How to determine the adequate limit of liability. This is something that we talk about all the time, about trying to explain why, because people will say, well, if I have a 10 million, they're going to sue me for 10 million. Well, Google is an amazing thing, and people find out very quickly, attorneys find out very quickly of how much someone is worth, and it doesn't even have to be how much someone is worth, but maybe your name. Maybe you have a popular, a well-known name of somebody that you might not have anything, but your parent did or your sibling did, and all of a sudden they think that you're tied with them somehow, some way. Our rule of thumb, and actually a lot of financial advisors and wealth advisors will say that you should have equal to your personal net worth. And that is, I will tell you that that's probably a good rule of thumb unless someone is more than 25 million of personal net worth. Then that's a whole nother conversation, and I'd be more than happy to have that conversation with you at a later date. But for today's topic, we'll just kind of talk about the lower liability limits that are available. A direct writer that we talked about before, they'll many times only go up to 5 million, and that's the max that they have. The insurance companies, I try to explain to people that if you have, let's say you're worth $10 million and you have a $1 million excess liability policy, you get in a car accident, and all of a sudden you get sued. And the insurance and the attorney sues you for the full 10 million because they know that you're worth 10 million. And you go to the insurance company, and the insurance company says, we only have 1 million on the hook. So I'm sorry, good, bad, or ugly, Mr. Claimant, here's our $1 million. Mr. Insured, you're now on the hook for the extra 9 million possibly, and now you have to pay it for your defense as well. So when you're purchasing an excess liability policy, you're not just purchasing the settlement or what could possibly be paid out, you're purchasing a defense cost along with it. So it's important that you actually have enough coverage to be able to cover the assets that and the investments that you've worked so hard to get throughout the years, so it's not just washed away in one little accident. Quick story, about 5-6 years ago, probably about 6 years ago now, my youngest son and my husband were driving, and I don't know how familiar you all are with further down in Virginia, but there's Interstate 64 going from Richmond to Virginia Beach. And my older son was playing soccer at a college down by Hampton Roads. And so they were going to watch him play a soccer game. And my younger son was following my husband on the interstate because he had to come back to work early to go to work. All of a sudden, traffic stopped immediately. No reason, very much like it does up here on 95. And all of a sudden, traffic just stopped. My husband veered off to the shoulder to not rear end the person in front of him. My son veered and swerved, not to avoid rear-ending my husband, overcorrected and hit my husband anyway. My husband went into the woods, and then my son flipped his car bumper to bumper 3 times in front of my husband. And I tell that story because, for one, it ended up being a very good, positive outcome. Neither one of them were hurt. We had 2 totaled out vehicles in a matter of 2 minutes. But I tell that story because there was no one else involved in that car accident, but it very well could have been a 10-car pileup. We then would have been sued by 10, 15, depending if there was multiple people in one car, we would have been sued by multiple people because it was, ultimately my son's fault. He wasn't texting, he wasn't, preoccupied. It's just traffic just stopped. And that kind of thing happens so frequently. If it be icy roads or slippery roads or whatever it might be, things happen so quickly that you just don't even know what happens until after the fact. So I tell people that because I think it's really important. Just pure accidents happen, and unfortunately, that can cause a lawsuit. So we just want to make sure that clients are protected for their assets because, another thing with lawsuits, they can garnish future wages. So it's not just what you have. They can garnish future income, if it be retirement, if it be investments, if it be wages. They can garnish that stuff. So you want to make sure that you have enough protection so that the insurance company pays it directly. Valuable articles. This is a fun one, and I could tell you stories upon stories about different claims and different things that I've insured on this stuff because I will tell you, people have some very unique things, that is for sure. There's differences in coverages. Valuable articles, a lot of people will say, it's okay, I have coverage underneath my home policy. But not all home policies, they usually do not have enough coverage within the home policy to cover certain categories. There's going to be certain limitations on no matter how good a home policy is. Those categories are going to be jewelry, antiques, art, silver, guns, furs, china. then what we call collections, or things that are a specific value. So it could be collection of sports memorabilia. It could be Chihuly glass. It could be a wine collection. It could be a baby grand piano. It could be an oriental rug, right? Anything of significant value. But the valuable articles policies, the coverage with that, first dollar is paid out. It's a zero deductible. It's usually agreed value. So you insure something, you insure a piece of jewelry, and something happens to it, they'll just write you a check if you don't want to replace it. And then it's what we call open perils. And that just basically means that it's covered almost for anything. I don't want to say everything, because it won't cover intentional acts. So in case I've had situations that clients have been upset with someone else and thrown diamond rings into the ocean, or what, you can't do that, right? That's intentional. Or wear and tear, if it be like an oriental rug or something like that. It won't cover wear and tear, and it won't cover intentional acts. But there are basically everything else. If it be a stone falling out of a ring, if it be just you leaving it at a hotel and all of a sudden it's not there any longer. It could be a sculpture falling and shattering. It could be any of that kind of thing. So those types of coverages are not going to be underneath any home policy. You have to get that extra policy and that extra insurance for that kind of thing. And then, to kind of circle back with the original slide, it's important to be able to have an agent that understands how to insure that type of thing. You can basically insure anything you want. We've insured costumes of the Wizard of Oz. We've insured Elvis Presley's jumpsuits. We've insured all sorts. We've insured a tree one time because it was historical. So there's all sorts of things that you can insure. Those are out of the scope, right? Most of us are going to have maybe some jewelry, maybe some art, maybe some antiques, that type of thing. And all of those things should be covered underneath the valuable articles policy. Coverages that are missed, and we've gone through some of these already, so I won't go through them anymore. These are not day-to-day types of coverages, right? But I do want to make sure that everyone is aware that they're out there. Domestic work comp, we talked about the nanny. Work comp should be given for any kind of domestic employee so that a lawsuit doesn't come back on them. EPLI, we talked about. Nonprofit D&O, we talked about. K&R, this is kidnap and ransom. This isn't just like the movie stuff, right? This is the kidnap and ransom policies actually also cover extortion. So if somebody's trying to extort money out of you with blackmail. Excess uninsured, underinsured motorists. This is something that is attached to the excess liability policy, but it goes up as an extension from your auto policy for the excess uninsured, underinsured on the auto. So what happens is that the auto kicks in first, and then this will go up and over that. This is basically in the event that somebody either doesn't have insurance or doesn't have enough insurance to cover your damages, but because the accident was their fault. We find a lot of this. There's a lot of uninsured motorists in Florida. There's a lot in California and a lot in New York. The excess uninsured, underinsured also covers you as a pedestrian. We actually probably about 8 years ago had a client that was here in DC, was walking across the street, got hit by a car. The driver had state minimum liability limits, didn't have very much liability. The person was a paraplegic. So they sued their own, it's almost like suing your own insurance company to gain those damages that you normally would sue someone else for, but they don't have anything to collect. Yacht, mega yacht, I should have put / watercraft. Boats are actually one of the most popular things now, because during COVID, all of a sudden everybody wanted to go buy a boat because that's the only place that they could be, is out on a lake or out on the ocean somewhere. So boats, watercraft of any sort, aviation, farm and ranch. We're finding a lot of these with the wineries that are popping up. And then the group excess program, this is more for employers. It's like a group program that gives discounted rates to employees or board members for the personal excess liability. And then flood and excess flood. That's the nemesis of us right now, is the flood and excess flood. So those are again, the flood is pretty common, but the rest of, and the boats are pretty common, and we actually put excess, uninsured, underinsured on every single one of our excess liability policies if the carriers offer it. But the rest of them, they're just extravagant coverages, but they are out there in case they are needed. That's it. So now I will take some questions, and then we'll wrap it up. Yes?
If your house is damaged and then it has to be completely torn down and taken away, is that typically covered in an insurance policy, or is that something you should ask for separately?
It is. It's actually covered underneath the replacement cost of the home. So when insurance agents are actually, insurance companies as well, are determining the replacement cost of your home, there's a lot of things that go into that. It's not just the sticks and bricks, right? So it's the sticks and bricks. It is the debris removal. It is the architect fees, the interior design fees. It is the, there was one time that was here, we had a claim in Georgetown, and they had to block off part of the street to get the equipment down there. That cost of blocking off the street is part of that replacement cost valuation of your home. So when people say, well, I can rebuild this for such and such, I'm sure you can, but are you taking into consideration all the soft costs? Are you taking into consideration the fee that the contractor is going to want to charge you, right? So that replacement cost is all within, that debris removal is all within that replacement cost. Yeah. Yes?
So right along those lines, because in my neighborhood, Saturday, we had a case where exactly that had happened. The house was total loss, everything, all the contents, fortunately, family was out, so nobody was hurt. So how do you assess that your house is actually covered to its true replacement cost, given today's market?
Yep. So the replacement cost of a home is very different than tax assessment or real estate assessment, right? Real estate is supply and demand. Taxes is who knows what. So the replacement cost, when you go to an agent, they should be, we always do, in fact, we just did this for one of Carmen's, we do a replacement cost estimator, and it helps us determine the replacement cost of the structure itself, right? It's a formula that the insurance carriers create in order, and it's a standardized formula. It's not like one insurance carrier will do a whole bunch and another will do another. It's a pretty standardized formula that you input all that information, and depending on the zip code, depending on the location, depending on all sorts of stuff, the quality of work, is it standard or is it customized or is it builder's grade, whatever it is, it determines the replacement cost. Then once that is established, I would say 90% of insurance policies, homeowners, will have an inflation guard on the policy, which means that every year, if you notice, the value of your home will increase incrementally, right? So usually, and historically, it's been anywhere between 3 to 5%. I've been on calls with insurance carriers in the past week, and they're going up to 9 to 10% because inflation is so bad at the moment. So every year, it should be increasing, and so hopefully, you're not completely underinsured from the policy that you purchased 10 years ago, right? But it's always good. Insurance companies many times will do, maybe come out to do an appraisal of the home, and that's complimentary with the insurance carriers. They'll come out to do an appraisal of the home, and they'll determine the replacement cost there. Yep.
So do those, so do those estimates include all the soft costs that you had explained?
They do. Yep. Yep.
Okay. I hate to do this, but we're going to have to cut this question short. She's going to be here around, and if you have any particular questions, I do have one question, though, that I want to ask, because I've been asked about this quite frequently lately, about all the ensuring that your home deed of trust does not get stolen. We see some advertisement on television saying, you know, you need to insure because people can actually steal your home and sell your home from underneath you if you don't have this insurance. Can you speak to that just briefly?
That's going to be more of a bond kind of insurance. It's not going to be a homeowner's policy, right? A homeowner's policy, you want to make sure that the trust or the LLC is listed on the home policy for liability purposes, because if somebody slips and falls, they're going to sue anybody that owns that house, anybody and everybody. So you want to make sure that that's listed, and you also want to make sure that that entity is protected for that asset, right? So that's what you want to do. For what they're talking about, that's more of like a bonding thing. Honestly, it's one of those things that they're more concerned about stealing the actual trust versus because you can't steal a home unless you steal the trust, right? So it's more of stealing the trust than it is the home.